Okay, we're getting on towards the end of chapter 12, and the last bit of sort of skill set that we need to develop here. We'll look at a couple of different techniques for helping us to deal with uncertainty in capital budgeting. Chapter 13, which we're not necessarily going to do, I'm going to include information about it, but I'm not going to require it. Chapter 13 has to do with sort of doing statistically based risk analysis for capital budgeting, I guess you'd call it. And although that is sort of the more sophisticated way of looking at risk in capital budgeting, we can look at a couple of different sort of additional pieces of information that talk to us or that show us something about certain aspects of the uncertainty associated with capital budgeting. One of those is to make basically a line chart that shows how sensitive the return on your investment is to the discount rate. And the second one is scenario analysis, which you have already done in a prior chapter in this class. So what I'm going to do is I'm going to show you the next slide to show sort of where we're going with the NPV, with the net present value profiling. But then we're going to go back to Excel and sort of talk about how you actually develop those graphs. Okay. So here's the next slide. And what this does, right, we've got on the x-axis, we have got the discount rate. And different types of cash flows are going to be differently sensitive to the rate at which you discount the further out cash flows, right? And this is hard to explain without looking at the cash flows themselves. So that's where I'm going to stop with the PowerPoint portion here. I'm going to just pop over to Excel and show you how to create a chart like this, and then we'll look at what these charts look like with different types of cash flows, and then hopefully it'll be more clear what it is that we're actually looking at when we're looking at one of these graphs. Okay, so here we are. This is the Excel workbook that we have been using, and I kind of took out some of the extra lines that we did, and what I've got here on these rows down here, let me scroll a little bit. So in these rows is kind of where we're going to be starting, sort of. This is our timeline, which I took and made horizontal because I like to think of it that way. So what we want to get at here is we want to just look and see what the net present value is of these cash flows at different discount rates. Okay, so we want to make a little table here that shows the discount rate and the net present value associated with that discount rate. Because of course the present value is going to change depending on what discount rate we use, right? So let's see, we'll say discount rate. In column A here, this is going to be a table, right? We're going to make a table that shows discount rates as different percentages, right? So let's just go from 0 to 35%. Make those percentages. Put them in the middle of the column so it's a little neater. So now what we need to do is calculate the net present value of this cash flow up here, right, at these various discount rates. So the way that we calculate that, remember, is the net present value of the future cash flows brought back to today's time. And of course we have to remember that the first argument in the net present value function is the discount rate. And then we subtract that initial cash flow, which in this case mathematically is to add a negative. Right, so that gives us a net present value of $76,560. at a zero discount rate. And a zero discount rate means that this $42,000 here is the same as $42,000 here today. So you could literally just add up all these numbers and subtract out 62,670, and you would wind up with 76,560. Now, let's take a look at that formula and see if we can get lazy and drag it down, right? So all we would need to do here is make absolute values for the line number, not the column number. So you stick that dollar sign in front of the line indication in the cell reference, as well as for the initial outlay. And with that, then we should be able to just drag all these down thusly. There we go. And so this kind of jibes with what we knew before. We knew that the internal rate of return, which is the rate at which the net present value is 0, was around 31%. And so we see that the net present value here at 30% is $1,200, and at 35% it's a negative $4,800. So we like these numbers. They make sense relative to what we've been doing before, so that's always good. All right, so here's our little net present value table, and I can kind of neaten that up, give it an outside border, give it a nice header, bold, put a little line under there. There we go. So that's a nice looking table. Okay, so now we've got our nice looking table here with the net present value and the discount rate. And so what we want to do is highlight the cells that have data, and you go Insert, Chart, and you find a scatter chart. And there is the scatter chart, but what we need to do is make lines here in between the data points. And so what you can do is right click, change chart type, and then here we actually have a menu that says scatter, and you got to go down and find the one that says straight lines, which is here, and there it is. So there is our net present value chart. Now, right, it's not really all that relevant to look at a net present value chart for one project. What you want to do is it helps you in a sort of a visual way to compare these two projects. You'll notice that Project A and Project B both have the same initial investment of $1,000, and Project B starts paying out sooner, and it doesn't have as big of a payout at the end, right? So let's figure out, first of all, let's get the data in here to figure out what the return is, what the net present value is at various discount rates. So at this point, we're going to copy your book and just do the discount rates at increments of 2 up through 26%. And so what we need to do is calculate the net present value of Project A and of Project B. And I want you to pay close attention to what I'm doing in my laziness, okay? Because you're going to wind up having to do a lot of this kind of stuff, filling in tables in your career. All right, so what we want to do first of all is put in the formula. So it's net present value of these cash flows at this rate. And these future cash flows, close the parentheses, and then we'll add the negative initial cash flow. Now, I want to be able to copy and basically autofill this formula as efficiently as possible. So let's look at this formula and think about what's going to change and what's not going to change when I pull it across and then down. Okay. If I want to pull this formula across to column D, first thing I want to do is make this cell reference the column stable. Okay, because if I'm going to pull this formula across to the next column, I want it to continue to refer back to column B here to the discount rates. Okay, so that's that, and then we want to go ahead and let the row numbers change as we pull it down. Meanwhile, though, right, if I want to copy this portion of the formula where I'm referring up to the cash flows over to column D, right? I don't want to set the column steady because that'll, if I'm over here, that'll refer over to these. What I want to do is set the row numbers as absolute. So that way, when I copy them across, it'll go across to column D appropriately, but it will also be able to pull down. So let's see what happens if I go to column D. This makes sense, right? So now here we are, we're referring to this column here and these rows up here. Okay, so now if I go ahead and pull these formulas all the way down, I can fill in this whole table very quickly. Right, so now still this is referring to these rows up here and this column here. All right, so this is good. So now what we want to do, I'm going to take this data again and just highlight this data, and I'm not going to finesse the formatting right now. Okay, so you can go over to this insert menu, and then over here there's all these chart options. If you grab this XY scatter chart and pick the one with the straight lines, there it is. Okay, now I want to note these two, if we look at these two profiles, okay, this one here in the blue, which is project A, okay, this is a riskier project. Okay, if you have a low discount rate, you're going to get a higher payback on project A. But if you get a high discount rate, you're going to get a lower, in fact, a negative net present value for project A. It's a steeper slope line. Project B is less risky. You are less likely to have an actual negative present value. Okay. And then the other thing that your book wants to bring out, which I think is interesting, is at what point, at what discount rate do these lines cross, right? I can see it somewhere in the between 10 and 15, right? So what we want to know is at what point are we indifferent? At what point of a discount rate are we indifferent between these two projects? Okay, so that's the crossover. At what discount rate are we indifferent between the two projects? So what you want to do is take the IRR, the internal rate of return, of the difference between these two cash flow profiles. And it gives you approximately 12%. And if we increase the decimals showing here, okay, so 12.48%. So that is the point at which we are indifferent between those two projects at a 12.48 discount rate. We are indifferent between those two projects. They cross. Okay. Okay, so that's all I want to discuss about net present value and a sort of a basic risk assessment, right? We can look and see just by eyeballing the net present value profile chart that project A is more risky than project B, right? It's got a greater variability in its discount rate. It's got a steeper slope. Now, Chapter 13 in your book discusses risk at great detail, but for those of you who are not going to attempt that, I do just want to make one point about risk. Okay, so a key point about risk in capital investments or capital budgeting, right? And this is not only the case for sort of corporate capital budgeting when you're looking at a project, it's also the case for investments, like if you're looking at startups, you know, if you like to watch Shark Tank or anything like that. Angel investors, venture capitalists, they, you know, deal with very risky investments. And so there's a lot of statistical things that you can do to try to get a detailed handle on risk. But what investors often do is they basically build in risk into the discount rate. Right, so this is why you hear about venture capitalists expecting a 20% return, a 25% return, very, very high levels of return, right? Because the return, the internal rate of return is, closely related to the discount rate. They look at the riskiness of an investment and say, you know what, you can tell me that you're going to give me $1 million 10 years from now, but I don't really believe it. So I'm going to discount your cash flows by 25%, by 20%. And so that's what risk really looks like in the world of capital investment. Okay, so that is chapter 12 of your book. Have fun.